Santacruz Silver Mining missed Q2 consensus. EPS came in at 2 cents, which completely missed the 37-cent target, and revenue hit $113.46 million, missing the $135 million forecast.
Right, but you have to note that revenue was actually up 55% year over year, and adjusted EBITDA rose 74% to $46.7 million.
Yeah, and even though management didn't provide formal quantitative guidance, which actually led Atrium Research to cut their full-year 2026 EPS estimates down to $1.06, the stock reaction was just crazy.
The reversal was massive.
It really was. After an initial 1% drop on the headline miss, it surged nearly 15% the next day, topping out at $9.54.
Yeah.
I mean, it is just wild for a stock to rally 15% when net income crashed 90% down to $2 million.
It sounds backwards, yeah. But when we get into the details of this deep dive, that massive net income drop was, well, it was basically a mirage.
Right.
It was driven by two massive one-time non-cash items. First, you've got a $36.1 million Bolivian tax expense, and
Wait, $36 million in unexpected taxes? How does a mining company just get hit with that out of nowhere?
well, it wasn't cash actually walking out the door. Bolivia went through the severe foreign exchange and inflation regime change.
Oh, so the local currency tanked.
Exactly. It devalued rapidly against the dollar, which artificially inflates the local paper value of the company's assets, and that automatically triggers a huge deferred tax liability on the balance sheet.
Okay, so it's basically a currency-driven tax ghost.
Precisely. And the second item, a $15.8 million non-cash fair value loss on a Glencore CVR, is a very similar story.
And a CVR, a contingent value right, is just a financial promise made during an acquisition, right?
Right. When Santacruz bought assets from Glencore, they agreed to pay a bonus if commodity prices stayed strong.
Oh, so because zinc prices went up, Santacruz owes more on paper.
Exactly. So again, a paper loss, not an operational failure.
Okay, let's unpack this, because what about the actual physical logistics? The report notes 53 days of national road blockades in Bolivia.
Holding up $17 million in concentrate exports, yeah.
I mean, I have to push back here. If you're a retail investor, a nearly 2-month blockade sounds like a catastrophic operational red flag. How is that just a mirage?
I mean, it is absolutely a serious jurisdictional risk you have to price in, but you have to separate a logistics delay from a production failure.
Okay.
The metals were fully mined, they were processed, the inventory existed.
I see. So it's essentially like your employer locking your paycheck in a safe. You did the work, the money is fully generated, but you just can't deposit it until someone finally gives you the combination.
That's exactly it. The value hasn't evaporated, and once those blockades cleared right at quarter end, that safe was unlocked.
Making it a Q3 story.
Right. Which means all that delayed revenue gets pushed into the next quarter, and the underlying operational leverage was exceptional once they could actually ship it.
Because consolidated silver production rose 17% quarter over quarter to 1.57 million ounces.
Led by the Bolivar mine, their silver production was actually up 32% quarter over quarter.
And that's the mine that flooded terribly in May 2025.
Yeah.
Right?
They finally finished the rehabilitation and are back in the dewatered zones. Because they can access those deeper areas again, they are pulling significantly higher ore grades.
Wow.
And over in Mexico, the Zimapan mine also rebounded from those severe Q1 ventilation and power grid issues.
So you're pulling higher quality ore without power interruptions, which explains the margin explosion. I mean, their realized mining margin per silver ounce sold skyrocketed to $50.30.
Up from just $15.63 a year ago.
That is just insane.
It's staggering. When institutional investors see operational leverage kicking in like that, they just look right past the headline EPS miss and bid the stock up.
Which makes sense. And briefly, with the blockades cleared, their post-quarter cash reserves have now surpassed $100 million, setting up a very strong Q3.
Oh, absolutely.
But I want to leave you with a final thought to mull over. We talked about that $15.8 million Glencore CVR loss earlier. The irony is that liability only triggers because zinc prices are rising. Is Santacruz actually being penalized on paper precisely because the commodities they mine are succeeding?
It really is the ultimate accounting paradox.
It is. For more daily earnings coverage to help you spot these financial mirages, make sure you follow the show.